Musk just announced that he sold about $4 billion worth of Tesla. He also, it looks like, sold some SpaceX stock, which is actually good news. I want to talk about this. The problem we have at Orange Capital Partners is that Tesla is our largest position. We're all in at Tesla. We've said many times Tesla is our cost of capital. And when the founder and CEO sells shares like that, there's a dichotomy. There's a clear cognitive dissonance happening in our brains where we have to justify being invested in this company for ourselves. And by the way, also we have fiduciary duty to our investors to have a, some sort of narrative or why are you invested in this? You have to have an answer. And to be fair, it's very difficult to find that narrative. And maybe the right thing is to sell and get out and just be done with it. It's a tough one because for years now we've been invested in Tesla for 10 plus years. We've been all in for many years now. All in, really, meaning we started maybe with a 50% position and then grew up to a 100% position because the stock just appreciated. So this is a tough time, and when I talk about this, the purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. Now, this is a feeling I've never had. This is new to me, and I'm glad that I can share it with the listeners because this is really unique. This is a learning process that I really have to go through, and I'm doing this sort of off the cuff. So I don't. There's no script here. I mean, typically my episodes have no script. I talk. I think about it a lot. I prepare mentally for what I want to say. Often during my episode recordings, actually, I develop ideas. In this case, I really don't know what the answer is. So I'm going to try to just go through the facts, like through the compartments in my brain that are occupied with this, and try to find the best possible answer to the question, what should I do next? This is a Not Even Wrong podcast. It's December 14th, 2022. This is Delco. For the day, the fund is down 1%. The market is down 40 basis points. For the year, we are down 63.4%. The market is down 15.6%. We're underperforming by 47.8%. Now, Tesla's been selling off in the last couple of days. Now we know why. Elon Musk has been a big seller. We know that already. We've been expecting that. He sold about $4 billion worth of stock, which, given where the stock is, of course, is pretty aggressive. I mean, the stock is trading at a very low valuation now. Still pretty expensive if you compare it to, let's say, car stocks. But Tesla's obviously not a car stock. So whatever. I mean, here's the problem. I'm not going to beat around the bush. Okay, you have the founder CEO selling shares at very low valuations. He doesn't believe in the company, or he has to cover debt. Whatever it is selling. It's an action. He's parting from shares. Now, given how big his position is in Tesla, it's perfectly understandable that he sells some, the same way we sold some shares because we had leverage. That doesn't mean we didn't believe in the company. We just had to manage our leverage, and that's what he's doing. At least that's what he's saying. But the fundamental problem is, can we still trust this guy? Because he's bought Twitter, and since he's bought Twitter, the stock has underperformed by, we're underperforming by 47%. I would say maybe half of that is attributed to Twitter. Okay, so it's not like we're losing money hand over fist because of this situation. It's there's the macro, and there's the high interest rates and the growth stocks being punished and those sort of things. If you look at comps like Nvidia or Netflix or Amazon and Facebook and those sort of companies, I think they're all trading very similarly, and Tesla should be trading better than most of these companies because the fundamentals of Tesla are still good, even if there's a demand pocket or if there's slowdown in China. I mean, we're still going to talk about 30-40% growth year over year. This is very good growth, and therefore also a situation that we believe the company should be trading at a good premium to other companies, and that's how the stock was trading for quite a while. The stock was trading even 3 months ago, 2 months ago. We were down for the year maybe 25%, 30%, which of course is bad, but but given where we are now, we wish we were in those territories. We have a big strain on our own capital. We have to manage our leverage. We exited positions other than Tesla. I mean, it's pretty bad. And I'm not even talking about our own investors. And this is the main problem as a hedge fund manager. You have to justify it to yourself, but you also have to justify it to your investors. You have a fiduciary duty to them to have a coherent argument. I mean, what are you doing? You know, uh, my son asked me yesterday, "What are you doing?" I mean, look, this is becoming almost like I'm having an affair with a crazy woman, and I'm embarrassed to admit it. I mean, this is how it feels, and it really is a problem because we at Orange Capital Partners we pride ourselves with a very clear and transparent approach to our business. The purpose is to invest to generate wealth by investing in fundamentally new concepts and engineering practices with large impact. Tesla fits that mission very, very well. But we're not generating wealth. We're destroying wealth. Elon Musk is destroying wealth. Why is he destroying wealth? Well, he seems to have a different mission. There is a dichotomy between what he wants to do and what Tesla wants to do. That's not in line. So one of the answers that we have for this situation, assuming we stay invested in the stock, is we want to see a clarification of who's going to run this company and what kind of a role is Elon Musk going to play in the company. We're okay with him stepping out. We're okay with that the stock has traded down enough to justify even that. We were okay with China being at jeopardy. We thought a couple of months ago, we said, the company probably is worth 300 billion without China. Well, it's worth 500 now, so it takes you to that $100 downside. And I think in situations like that, look, we're still invested, so we're gonna assume we're staying invested. We're not assuming an exit yet, because the exit would be really driven by the fundamentals of the company, the competitive landscape of the company, the pricing, the technology, all these things not working out. Then we have to reevaluate, because the concepts and the engineering practices that we're investing in, or if we use the natural Sharpe ratio, which is our measure of sort of expected return and what we should invest in, or the answer to what we should be investing in, looks at the potential of a company and the amount of errors they make and the cost of error correction, all of these things. If that formula doesn't work out anymore, then we have to look at alternative investments, or just being cash or Bitcoin or whatever. We think that Tesla is still worth investing because the underlying concept, the engineering practices, and those sort of things are still intact. What's not intact is the leadership. We need a leader. We need somebody to answer questions. What kind of pricing should Tesla pursue in China? What should they do about the AI? How far should they go in pushing AI? And what should they include and not include in the next versions of hardware and software? What is the pricing of, let's say, the charging infrastructure, the opening up of the charging infrastructure? All of these things. There's many other. I mean, the exciting thing about Tesla is that it is an accumulation of startups. So there's so many interesting questions to ask in each business line. The insurance, how should we price insurance? Should we use insurance to entice people to buy the car? For example, right now in the Bay Area, you can buy used Model 3s for under $40,000. And that, I think, is a pricing experiment they're doing, because they want to see if lower segments of the income spectrum is gonna buy the car if it's if it costs 37,000 versus 40. I mean, there's a psychological barrier. So there's experiments being done now. These experiments can be done by managers, senior managers, certainly, but I think there's a reason why we have a CEO, and we right now don't have a CEO. So I think to sort of cut a long story short here, we're not as much let's say, we're not angry, or we're not unhappy about the actual stock sale of Tesla. That's not such a problem, because we know why he's doing it. Well, he bought Twitter, and that is unfortunately a bad situation, and it needs to be financed. What we're most concerned about is the discrepancy between where the CEO is and where the company is, it's not in line. The mission, the daily, like we've said many times in this podcast, your daily agenda that's who you're going to be in the next 5 years, right? If your daily agenda is dealing with Twitter and the speech coercion and thought coercion that was going on with Twitter before he took over, and you're trying to unveil that, and you're trying to maybe change the political and a public narrative around how bureaucrats overstep their powers, such as, let's say, the health department in the U.S. during COVID, and how now voices are emerging on Twitter and outside of Twitter. But thanks to the Elon Musk initiatives, we have a much more open discourse about all the wrongdoings which happened at the government level. So if we take all of this into account, this is great, but it's not in line with the mission of Tesla. The mission of Tesla is not to improve humanity or democracy. The mission of Tesla is to decarbonize energy, or actually to accelerate the advent of sustainable energy. That's what the mission of Tesla is. And while maybe tangentially, of course, we need a free society. We've said that many times. A free society is the ultimate vector which drives wealth and wealth creation and new ideas and all that stuff. So yes, I mean, you can say that maybe Musk is fighting for freedom because otherwise nothing will work. Fair enough, but still, we can't have this CEO-less company going through really a tough time right now. It's tough because we have a macro headwind, we have high interest rates, prices are high. So there's a lot of things that need to be dealt with as a CEO, and we need a CEO. So I guess my conclusion here is the following. I want Elon Musk to give a clear statement of what his role is going to be with Tesla and Twitter, and how he's going to separate his time. And I want to have a day-to-day operation that either he or somebody else runs. It could be even a positive. Maybe he could do the same with all these other companies, and therefore have a much better structure. And he can be sort of the CEO of X and all these companies under him. So a little bit like Larry Page with Alphabet and Google. That worked out pretty well. By the way, we have other examples. We have, for example, Lululemon, which is, of course, a very different company. But there, the founder was ousted. And he was ousted because of similar political controversies. But then the company did well. I mean, because the foundation was really good. And I always, when I discuss his biography, I feel like he's very similar to Elon Musk in many ways. He's a typical founder type. And therefore the similarities are really good. Apple, the first version, the first stint of Steve Jobs at Apple, I don't think is a good example because he didn't build a sustainable organization back then. And in the second stint, he did, and Apple was a big success also post Steve Jobs. So there's definitely room for a company like Tesla or any large tech company to change their CEO. I mean, that's not like impossible. And we have the same situation with Facebook or Meta, where Mark Zuckerberg is supposedly interested in doing other things. So there's a precedent. What we want is clarity. We need clarity, and we also want to understand things like the financing. This has been a big frustration for, I think, pretty much anybody, because it was supposed to be just a certain amount of shares, a certain amount of margin shares, and then things deteriorated. Twitter became much, much worse, and now he's selling probably about 4 billion in Tesla. I would think that he's selling a similar amount in SpaceX. So he keeps selling shares. He keeps financing portions of that whole deal, which was way overpriced. The fundamental problem with the Twitter acquisition, there's two fundamental problems. One is it was overpaid, and second, it's distracting Musk. And these problems are interrelated. Why are they interrelated? Because on the one hand, you have, when you overpay for something, you struggle to come to terms with it. If Musk had bought Twitter for $5 to $10 billion, which maybe you could have argued that's fine, like you're buying a network, you're buying something, a brand, and then you can make it work, not make it work, fire people, replace all the tech, move the headquarters to Miami, start from scratch, have something. It's not crazy to do that. It's not like bad, but what Musk did is irresponsible. He is using us shareholders. We're, like I said, I think in the previous podcast, I'm not sure if I wrote it or said it, doesn't matter. I'm going to say it again. We Tesla shareholders, we're the conscripted freedom fighters here. So we're conscripted, meaning we're involuntarily being dragged into a war that's worth fighting. Let's be clear. I mean, I just heard an interview today with Jay Bhattacharya on another podcast, and he's coming out talking about all the incredible discrimination you have to endure, and the coercion and the top-down shutting up and real manipulation of information that he was exposed to. So all these things are related to the Twitter situation. I have no illusion about that, and it's a good thing. But we Tesla shareholders are being dragged into this involuntarily because we didn't sign up for this. You know, the right way to do this would be to, you know, almost organize something like a DAO, where if you want to participate, you put your money, you put your energy, you put whatever you want to put it in, and then you go fight. We're in this business as investors because we want to change the energy and transportation market. We want to decarbonize energy. We want to, improve self-driving, autonomous driving. Those are the kinds of businesses that we're invested in. We're not invested in a freedom-fighting operation. So that's the big problem, and we want this to be separated. This can be separated in many ways. One is Musk stays CEO of Twitter, runs Twitter, puts on a CEO in Tesla. Maybe he stays involved in the big picture decisions, or he drops Twitter, comes back to Tesla. That's also, but it has to be clear. So this is an open appel to Elon Musk also to be clear about this. This is what we need. So now to come to the big question that I started the podcast with, this episode with, and this is really the question, okay, what do we do now? What do we do next? Are we going to stay in this or not? The answer is we're still in this. We're reducing our position based on the leverage and based on some projections that we have, certainly just based on our financing needs and that kind of thing. But nothing, we're not reducing our position because we're less interested in Tesla. And the reason for that is that maybe it's the prudent thing to do, but we've done a lot of unconventional things when it comes to portfolio management. We have high concentration, and we're not doing what a lot of instinct, like a lot of times in this business, I personally think that you should be doing what's not instinctual. And this is very dangerous, but what I'm trying to say here is that my instincts tell me to reduce the position, let's say to 30% of the portfolio, and then reinvest the capital somewhere else. But I'm feeling that if I make money somewhere else, I'm going to make a lot more money with Tesla. And if I don't make money, then I'm better off selling everything. So this is the fundamental problem with all this, like, oh, I'm going to reduce, diversify. If my thesis here is right on Tesla, I'm going to make a lot more money. And if I'm wrong, I need to get out. But to have like a 30 or 40% position, it's just not the way we want to operate. And the thing is here, like as portfolio managers, sometimes we feel like the industry is converging with us. That's when we make money. And sometimes we're diverging with the industry. It is normal because the real world out there, the reality is very volatile. It's very idiosyncratic. Things happen. It's kind of like a Cambrian revolution. There's always things happening. There's crypto. There's collapse of FTX. There's this. There's that. There's a lot of things happening. Musk as a person buying Twitter, doing this, doing that. So there's a lot of things happening. Sometimes we converge. Sometimes we don't. It's impossible to always be convergent. And hopefully sometimes we converge and sometimes we don't. How can we increase the amounts of conversions and decrease the damage when we diverge? Well, by try and error, by error correction, and all of those things. So the question now is, of course, should we correct our error? Was it an error to invest in Tesla? The answer is no. It's not an error to invest in Tesla. The company is still, we have to separate the company from the man. And that's possible. That is, maybe it was unheard of 6 months ago, but now it's possible. We can actually separate the company from the man. And by the way, it doesn't mean that he has to step out, but we need to separate that because his mission now is different. And the company as a company is still worth something. I mean, it's maybe not worth the 20 times sales that it was worth at the peak, but it could be worth 8 to 10 times sales, assuming it keeps growing 30, 40%, and it keeps increasing operating leverage and therefore increasing revenues and cash flows. It's perfectly possible. So what we're trying to say here is that we are in this for the company and the mission of the company. And the CEO and founder, if he has different ideas, then he should come and explain to the investor base what his intentions are, how he's going to separate this, and how this is going to look in the future. If that happens, we're happy to stay shareholders. If it doesn't happen, then we might have to exit. Hopefully that doesn't happen. Again, there's nothing wrong with the company. What we need is clarity from the board and from the CEO, what he wants to do and how he wants to align his intentions and his mission with the mission of Tesla. Because we're invested in the mission of Tesla, which is to accelerate the advent of sustainable energy, to decarbonize transportation, to decarbonize the energy infrastructure, and to increase the autonomy in driving. Thank you.